In this video, I'll be focusing on real estate investing, stocks, especially pertaining to an investment portfolio, mortgage-backed securities, debt securities, and diversification. When someone has an investment portfolio, it's very important that they diversify. We diversify a portfolio by spreading out our money over a large amount of investments to spread out the risk. So one might have an investment in stocks, real estate holdings, as well as bonds. It's important that an investor diversify their holdings because no one wants to just have all their eggs in one basket. Let's say you just had all your most of your capital in mortgage-backed securities, and then the mortgage-backed security market isn't holding up well, then you'll lose all your money on defaults. Or no one wants to have all their money into real estate alone because let's say the market decides to enter in a bear market and you're not having a positive cash flow to keep up with those properties, and one doesn't just want to have all their capital in stocks because let's say the stock market decides to crash or decrease in significant value. The most important math when doing real estate investing is the net operating income. Now, this can be income that one is made after obtaining maybe some form of rent payment. Now, the net operating income would be the income left over after we paid our property management, we account for vacancy loss, and we also account for our reserves. So pretty much all the expenses before the debt service. Real estate investing can also be a good tool for those who are looking for long-term income. Now how someone can do this through diversification is they could also have in their portfolio mortgage-backed securities, which are pretty much debt securities. It's important that an investor understand mortgage-backed securities because this can be a great way to have fixed income based off the amount that you're willing to invest and the yield on that particular security. Another way someone can diversify their portfolio is through stocks. Now, stocks could bring you a lot and benefit you in a lot of ways. One way stocks can benefit you is through capital appreciation, which is basically you buy low, sell high. Now, everyone has their idea of what number they're willing to possibly make off of their stocks, like their return that they want to have over a certain amount of time. This is definitely something that someone would want to go over with like an investment strategist. You might want to have a passive you might want to have a passive investment strategy or more of an aggressive investment strategy. The way it goes, diversifying an investment portfolio is definitely worth it. I would recommend someone have real estate, stocks, maybe a few mortgage-backed securities in their portfolio to help spread the risk. From also doing a lot of research, the average return on a portfolio annualized is about 8.22%. So that's pretty good. So that means if I had $100 in an account, by the end of the year it should be worth $108, which pretty much that's about growing as faster than inflation, which is roughly around 2% a year, which is what the Fed wants to keep. So basically, you can make money by having an investment portfolio is better than sitting your money in the bank, because if you sit in the bank, your inflation is going to outpace what the bank can offer you, which is about 0.01%, which is pretty much a tenth of a percent. Which pretty much, if you had $100 in your bank account, but by the end of the year you only make 10 cents. So I don't know, $8 versus 10 cents sounds like a lot better to me.